I'm often asked, how can I invest without any stock market experience? Today, I'll walk you through it step by step. But heads up, you might not have experience, but you still need some basic investing knowledge. I'll explain this in depth in this video, but basically, that's what we're going to be talking about today. Investing in stocks can seem intimidating at first, full of complex terms and charts that look like a maze. But please do not worry at all. I'm here to demystify every single part of this and show you that with the right tools and knowledge, absolutely anyone can start investing in stocks. In today's comprehensive video, we're going to cover absolutely everything you will need to take your first steps into the world of stock market investing, from understanding what stocks are and exactly how the stock markets operate, to practical strategies for beginners and how to avoid the most common pitfalls and mistakes. We'll also discuss in detail how to select and pick out your first stocks, how to build a diversified portfolio, and how to stay informed so you can make well-informed and strategic decisions. And above all, remember this: the key to success in investing isn't having thousands or even hundreds of years of experience, but rather being willing to learn, being patient, and making informed decisions. So without further ado, let's get started. The basics of stock investing. To start our journey into the world of stock investing, it's essential that we understand the basic concepts. What exactly are stocks and why do people invest in them? Simply put, a stock represents a small share of ownership in a company. When you buy shares of a company, you become a shareholder, which means you own a fraction of that company. Companies sell shares to the public to raise capital, which they then use to fund their operations, expand, or develop new products. Now, why do people invest in stocks? Mainly for two reasons. First, capital appreciation, and second, dividends. First, capital appreciation refers to the increase in the value of stocks over time. For example, if you buy a stock for $10 and its value rises to $15, you've made $5 per share. On the other hand, secondly, dividends are payments that some companies make to their shareholders, usually quarterly or annually, as a way to distribute part of their profits. It's important to understand that stock prices fluctuate constantly in the stock market. These changes are due to various factors, such as the company's performance, overall economic conditions, industry news, and even investor sentiment. This volatility is what makes investing in stocks both exciting and risky. But before we get into more complicated topics and issues about risk and safety, I just want to bring up something here. And that's that all of this is always based on the basic concept of bartering, of exchanging things. And basically, it's the concept of supply and demand. Obviously, through news, through the progress or setbacks of companies and their profitability, their production, and so on, people will decide whether or not they want to invest in a company. If they want to do it, obviously this will create demand. In other words, they want to buy shares. And on the other hand, there are people who may have already previously acquired shares, and right at that moment, since the stock price has gone up because there are so many people interested in it, what are they going to do? They'll make offers. In other words, they'll sell their shares directly, either at the market price or at a price they set themselves. Yes, obviously there are many layers on top of this, like technical analysis, fundamental analysis, and several other things we need to look at. But let's say the foundation of it all is there, in supply and demand. How many people are willing to buy and, above all, pay a certain price for that stock? And how many people are willing to sell, whether at a price they set or at the price currently available in the market? But anyway, let's move on to talk about something even more important, and that's the risks. It's crucial that we understand that investing in stocks involves risk. The value of your investments can go up or down, and there's a possibility you could lose part or all of your initial investment. However, historically, the stock market has provided higher long-term returns compared to many other forms of investment. This is mainly referring to the US stock market. If we look at emerging market stock exchanges, we might see a different situation. Before you start investing, it's essential to get familiar with some key stock market terms. For example, first of all, what is a stock exchange? This is the market where stocks are bought and sold. Famous examples include the New York Stock Exchange, also called the NYSE, or in Spain, the Madrid Stock Exchange. Second, the stock index. This is a measure of the performance of a group of stocks. For example, the IBEX 35 in Spain, or the well-known S&P 500 in the United States. Third, what is a broker? This is the intermediary that carries out your buy and sell orders for stocks. In other words, it's the platform through which you'll invest. Then, fourth, dividends. As we mentioned before, this is a distribution of a company's profits to its shareholders. Fifth is market capitalization. This is the total value of a company's outstanding shares. Because remember, a company decides how many shares it issues, and based on that, those shares will have a price. And together, that will be the market capitalization. Next, let's move on to the price-earnings ratio, also called PE, which you'll see on many investment analysis platforms. This is a metric used to value stocks, comparing the stock price to the company's earnings per share. Understanding these basic concepts will help you navigate the world of stock investing with more confidence. Remember, you don't need to be a financial expert to start investing, but having a solid understanding of these fundamentals will give you a foundation on which to build your knowledge and investment strategy. All right, we've covered the basics. Now let's get a bit more specific. Getting ready to invest. Now that we understand the basics of stock investing, it's time to get ready to take the leap. But before you buy your first stock, there are several important steps you need to take to make sure you're ready to start your investment journey. The first crucial step is to set your financial goals. Why do you want to invest in stocks? Are you saving for retirement, to buy a house, for your children's education, or simply to build long-term wealth? Your goals will influence your investment strategy, including what types of stocks to buy and how long you plan to hold your investments. It's important to be specific with your goals. Instead of just saying, in quotes, I want to make money, you can set a goal like, I want to save $100,000 for a down payment on a house in 10 years. Having clear and measurable goals will help you stay focused and motivated, especially during the inevitable ups and downs of the market. The next step is to assess your current financial situation. Before investing in stocks, make sure your basic finances are in order. This includes, first and foremost, having an emergency fund. Ideally, you should have saved the equivalent of 3 to 6 months of your monthly expenses in an easily accessible savings account. Second, pay off high-interest debt. If you have debts with high interest rates, and sometimes even with low interest rates, like credit card balances, consider paying them off before you start investing. Once your basic finances are in order, the next step is to determine how much you can invest. It's important to invest only the money you won't need in the short term. Investing in stocks is more suitable for long-term financial goals, since it allows you to ride out short-term market volatility. Now let's talk about risk tolerance. This is a crucial concept that every investor needs to understand. Risk tolerance refers to how much volatility or potential loss you're willing to accept in your investments. Factors that influence your risk tolerance include, for example, first of all, your age. Generally, younger investors can afford to take on more risk since they theoretically have more time to recover from losses. Second, your financial situation. If you have a stable source of income and little debt, you might feel more comfortable taking on more risk. Third, your goals. If you're investing for a long-term goal, like retirement, you might be willing to take on more risk than if you were saving for a short-term goal. And finally, obviously, and just as important, your personality. Some people are simply more comfortable with risk than others. Understanding your risk tolerance will help you build an investment portfolio that lets you sleep soundly at night. If you find yourself constantly worried about your investments, it might be a sign that you've taken on more risk than you're comfortable with. Another important aspect of preparation is financial education. Even though you don't need to be an expert to start investing, it's important to keep learning about investments and personal finance. This could include reading books about investing, following reliable financial blogs, watching educational videos like this one, for example, or taking online courses on investing. Finally, it's crucial that you understand the concept of diversification, or as the famous saying goes, don't put all your eggs in one basket. This is a fundamental principle of investing, which means spreading your money across different types of investments to reduce risk. Don't put all your eggs in one basket, as the saying goes. In the context of investing in stocks, this could mean investing in stocks from different sectors, company sizes, and geographic regions. Remember, above all, preparation is key to success in investing. Take the time to set your goals, assess your financial situation, understand your risk tolerance, and educate yourself about investments. These steps will put you in a strong position to start your journey into stock investing. Well, we've learned quite a bit already. Honestly, I wish I'd had all this information so easily accessible and broken down like this in the past. For those not from Colombia, it's easy to understand because many of these things are complex for someone just starting out who wants to learn about the stock market, investing in stocks, and so on. But let's just say that the way I'm presenting it here makes it pretty easy for you. And now we're practically at the last step, which is basically making your investment decision after having understood all these concepts up to this point, choosing a broker, and taking your first steps. In the description, I'll leave you the link to the broker I personally use, in case you want to try it out and just take your first steps there. And now that you've prepared yourself mentally and financially to invest, it's time to take the next step, choosing a broker and starting to buy your first shares. This process might seem overwhelming at first, but don't worry, we're going to break it down into manageable steps. So first of all, what is a broker? A broker is a company that acts as an intermediary between you and the stock market. It allows you to buy and sell stocks and usually offers tools and resources to help you make investment decisions. In the digital age, most brokers operate online, which makes investing more accessible than ever. When choosing a broker, there are several factors you should consider. Obviously, I'm telling you about the one I personally use. However, you should do your own research and say, I want to invest in this, I want to invest in that. That completely depends on you. First of all, commissions. Many online brokers now offer low or even zero commissions for buying and selling stocks. However, make sure to read the fine print, since they may charge for other services. Second, the minimum investment factor. Some brokers require a minimum deposit to open an account, while others let you start with any amount. Third, the types of accounts. Make sure the broker offers the type of account you need, whether it's a regular investment account, a retirement account, or both. Fourth, research and educational tools. Look for a broker that offers educational resources and research tools to help you make informed decisions. Fifth, easier use. The broker's platform should be intuitive and easy to navigate, especially if you're a beginner. And finally, of course, something very important, customer service. Good customer service can be invaluable, especially when you're just starting out. Once you've chosen a broker, the next step is to open an account. This process can usually be done online and typically involves providing personal information such as your name, address, tax identification number, and bank details. You may also have to answer some questions about your investment experience and your financial situation. After opening your account, you'll need to fund it, top it up, or deposit money into it. All of these terms basically mean the same thing. This is usually done by bank transfer or direct deposit from your bank account. Remember, only invest money that you won't need in the short term. Now comes the exciting part, buying your first shares. But before you click the buy button, it's important to do your homework. Here are some steps you could follow. First, research the companies you want to invest in. Before investing in a company, you should understand its business model, its growth prospects, and its potential risks. Read the company's annual reports, recent news, and you can also rely on expert analyses. Second, analyze the fundamentals. Look at key financial metrics, such as revenue, earnings, debt, and profit margins. Compare these metrics with those of other companies in the same sector. And I know this seems really hard for a lot of people, but let me put it another way. Imagine you're the one who started a company and for some reason you need an investor. What's going to happen? You're going to offer people who have the means to invest in your startup or business the chance to become investors. But what are they going to say to you? Whether the investment is really worth it or not. How will they know? Simple. Metrics. You can tell them how much you sell per month, how much profit you're making, what the profitability is for each product you sell, and a whole list of other things. Looking at it this way, it's not that complicated. Basically, these are huge multinationals that are publicly traded. In some cases, not so much, but most are. So look at it this way. Obviously, now put yourself in the shoes of that investor. If you see negative numbers that aren't looking so good, or the company's making bad decisions, then you're going to decide not to invest there. Then third, consider the valuation. Use metrics like the price to earnings ratio, which we talked about earlier, to evaluate whether the stock price is reasonable compared to the company's earnings. Fourth, diversify. Don't put all your money into a single stock or a single sector. Consider buying stocks from different sectors and regions to diversify your portfolio. And lastly, start with what you know. Warren Buffett, who is one of the most successful investors of all time, advises investing in companies you understand. You can start with companies whose products or services you use regularly. And this is something pretty interesting. There are people who think that in the stock market, companies are usually extremely huge and that sometimes they don't even use any of their products. For example, one could be Google, which is the browser we use literally every day. Also Apple, since we use iPhones daily for those who have them, and there are many other companies like this. So if you trust those companies, you can also invest in their stocks, obviously after analyzing them first. Once you've decided which stocks to buy, the purchasing process is pretty